it kind of doesn't make sense when you just look at inflation. It is trending lower now for a third straight month, yet the ECB rhetoric is trending higher when higher rates and a wind down of QE is concerned. Why?
There's almost like a Fed envy going on. I mean, if you think about it, the Fed also had a dilemma all throughout last year. We had low inflation, but the Fed still delivered 3 hikes. And so I think central banks are clearly, it's going to take a lot for them to not get, to stop their easing process. They're going to keep, slowly slowing down their easing process. And I think they're on track to get out of ECB QE. And I think it's going to take a lot more than just this weakness that we've had right now.
Really big spread between treasuries and bonds, as wide as it possibly could be. How's that going to reconcile anytime soon?
True, but if you look at the optics of what that really implies, if you look at the actual pickup, if you adjust for hedging costs on the FX side, actually, bonds actually still look relatively fair or attractive to treasuries. And so, I mean, I think this is the dilemma that we all face, that we cannot look at history as a sort of a guidance.
Lisa?
I think, George, it's really interesting that you say that they have Fed envy, because it doesn't seem like Mario Draghi seems particularly eager to start raising rates. Even tapering, he hasn't been particularly vocal about. And this certainly isn't going to push him to do that. This somehow gives him sort of a free pass. And a lot of people in the market are kind of treating this as giving him more time to formulate exactly how he wants to back away.
True, but I mean, you also have to be confident on the outlook. We are pretty optimistic as a house for European growth, and as long as that's still out there in the backdrop, and they're going to unwind the QE program eventually. Getting too nitpicking at this point is going to send mixed signals, and so they should just kind of run the course.
George, we do have a really strange situation in Europe in so many ways when you look at the market, and take your pick as far as fixed income is concerned. But ahead of the Italian election, I do want to pull up something that HSBC pulled up themselves, and it's the spread between credit in Italy and the sovereign in Italy. Now, the intuitive way of seeing this spread would be for sovereign yields to trade below credit yields. That's not what you see in Italy. In fact, that's not what you see across much of Europe either. What is going on? Why does credit in some places in Europe, the yield trades below the sovereign?
I think on a standalone basis, a lot of corporates probably have better fundamentals in terms of debt dynamics, and I think that plays a big role there. And also, the ECB is doing some sort of corporate QE buying as well, so that also changes the optics.
They're totally distorting the market. I mean, you're being so diplomatic.
I love the way you've tried to rationalise what's happening in European fixed income markets. There's nothing rational about that, is there, George?
I'm being fair to my European colleagues over in London.
There's nothing. I'll speak for you then. There's nothing rational. The market doesn't have enough liquidity to offset the fact the ECB is going in and buying corporate bonds.